Hey guys, welcome back to another episode of Ryan Makes Sense, where we focus on personal finance, investing, and analysis. Today we are going to take a deep dive into the Finviz data points that make up the screener. Uh, Thankfully, I don't have to break down each definition because Finviz does offer a page that goes through these definitions for you and breaks down each data point. Um, so I'm going to leave this up to you to review and research on your own, but I will be creating a separate video where I will talk about each of these definitions and you can write them down as I go through because when I was doing this myself, I had wished someone was reading this to me while I took notes so I didn't have to look up, take notes, look up, take notes, things like that. So Finviz, thank you very much for having those definitions ready for everybody. I will post the link to those in the description of the video so you can go through those, take notes on your own. But like I said, I will be going through those in a separate video, just describing the definitions of each data point. I also wanted to go over, oh, hey there. If you subscribe to my channel, a new IPO is manifested and I really appreciate it. um, so I wanted to go over the homework from the last video. So there was two parts. Number one was making an account on Finviz. It is free. Again, this tool is going to change your life if you stick with me. Um, it'll make you some money, hopefully. So number one, make an account. It's going to make things easier to track and monitor in terms of screeners and performance, monitoring stocks that you maybe want to buy but don't buy because you don't want to put money on the line, things like that. So make an account, it's free. And then also the other part of the homework was to think of products, services, goods that you use or see or visit, and see if they contribute to a company that is publicly listed. So here are my 10. I'm not going to go through them, but it's essentially encompassing of the day-to-day activity of just going for groceries, going downstairs, seeing candles lit, looking in your cupboard, making food, using laptop monitors, using a mouse and keyboard, things like that, food, things you stream. So, again, here's my list. I highly encourage you, if you have not done this already, to please do so. It will help you think about these kind of things as you are in your investing journey. But another part of this video I wanted to talk about was risk tolerance. Someone who is 18 is going to have a different mindset than someone who is 99. So I just wanted to cover those bases really quick, and I'm just going to go ahead and do a little pop up. So there are four main areas that people identify themselves as in terms of which area that they are. So people who are 18 are going to identify more with the growth area. They have the time to invest in companies that can make a mark in the future or down the road. So if a company is volatile, it goes up, down. They can weather that versus someone who's 90 who may need that money and cannot stomach seeing their finances or their life savings go up 20%, down 30%, up 30%, down 50%, things like that. And then income stocks are generally stocks that provide you income. Those offer dividend yields. Think Target, Walmart, AT&T. AT&T has a pretty big dividend. There are all types of companies from retail stores to utility electrical companies to you know TV broadcasting providers, phone providers, Verizon, AT&T. So those typically, if you have money in those, they will pay you out every quarter. And so when it is on Finviz, it'll show like maybe 5%. that means it is 5% for the year. So you will get 1.25% every quarter, which will equal 5% in the year. So if you have $100 in AT&T, you'll get $5 at the end of the year, $1.25 every quarter, so on and so forth. Value stocks are typically stocks that are priced below where they should be based on financial status and technical trading indicators. Um, I will show you ways how to value companies and find out if they are um, undervalued or overvalued. So, and we can also do that in Finviz. So that'll be another good talking point to go over after we are familiarized with these data points. And then the last one and least likely to ever help you is bonds. This is the safety area where people who are deathly afraid to part with their money, they can put their money in bonds and get a guaranteed return. Um, the bond prices go up and down, but you are guaranteed a return. So again, they're super safe. I think in about 10 years, um, you could get a juicy return, but I mean, the inflation each year, price swings, and then finding your own quality stocks that can return the same value in a fraction of the time. I would not recommend bonds for anybody at any point in their life. Um, so those are the risk tolerance areas. As this channel does continue to move forward and we get into some challenges, we will be focused on mainly the growth value, finding plays or companies, stocks that are in the growth stages, but they also provide value and are making money. They have predictable quarters, predictable earnings, things like that. So yeah, I would suggest that you kind of pick a an area that's right for you. I would say if you're 18 to 55, I would say growth is good. It doesn't have to be 100% of your portfolio, but I think the younger you are, the more that it should be. um, Income, I think that is mainly for people who want a steady stream of income, where you might not get a return on your stock, but you'll still make like your $1.25 or 10, 25, $100, whatever. Those kind of stocks will not perform as well as value over time. Or I'm sorry, they will not perform as well as growth over time. Value stocks, those can be great finds. For example, buying Wells Fargo back when it was $21 and now it's like 42, 52. That was a great value find. There are also value traps, which we can discuss later. Again, get familiarized with all of the Finviz data points first. We need to have a good understanding before we can find good stocks that we are going to invest in. And then don't get into bonds, but you are free to do what you want to do. And again, I'm not a financial advisor. These are just opinions. And these are the same opinions that helped me get to seven figures. So just putting that out there. And then lastly, I'm just going to post this agenda really quickly. So what we are going to do is go through all the Finviz data points. You can do this on your own time. I will be making a separate video just going over definitions so you can write it down. Please, please, please do so. This is really important in terms of our growth on this channel and for you to really get confidence and a solid foundation using Finviz and investing in the stock market. You don't have to be an economist or economics major or a son or daughter of someone who worked on Wall Street. You can definitely learn the ropes this way, and I highly encourage it. This is a very important step. So take the time. I'm going to read things off. If you don't understand them, I would pause the video, Look up the definitions on Google, see how they pertain. Um, and once you do that, um, try to, if you can, determine your investing tolerance. I am going to be more focused on growth value, which I think you should as well. That is going to be looking at companies that can provide 15 to 1500% returns depending on where we invest or where we find them along the way. You know, we wouldn't want to invest in, like, let's say Southwest Airlines right before the pandemic. These types of things are predictable in terms of patterns. So we definitely would have seen that from a mile away. So um, yes, find your tolerance. You can always go safer than what I'm doing by adjusting the data points on Finviz that we'll go over. I will provide commentary on how you can choose a safer alternative. So we'll do that. I'll show you how to create the screener, and then we will save the screener results into our, let's say, alert book, our contacts. So basically, we'll have a list of companies and we will chart them out, which will be another video again. Um, and we will put an alert on when the company will be hitting that inflection point for a sharp move up or a sharp move down. So we'll put it on our radar so we can monitor the day to day, the week, the monthly, insider traction, what's going on. So, yes, your risk tolerance, figure out what you want to do. And then also, I don't know if you've heard this saying before, but history has a tendency to repeat itself. Hindsight is 2023. So this is probably my favorite thing ever. So have you ever said, man, I wish I got into Bitcoin in 2006, or I wish I invested in Amazon at $10, or I wish I invested in Tesla at $30 after the stock split price? Well, now we can. So what we can do is, let me go ahead and do some edits here really quick. Let's take this off the screen. And we're going to go to Wayback website. And this will show us companies where their financials were in Finviz before they blew up. So let's look at, I was thinking Amazon, but let's just look at GameStop because that was ridiculous, right? So we're going to go to Finviz and we're going to type in GameStop, which is GME. And we've got GameStop. And now we're going to copy this link up top once it loads. Whoops. Copy. And we're going to go here. And now we're going to look at what the financials look like before the big move up. And then we can apply those financials to a potential screener. We could call it the GameStop explosion screener. So I forget when GameStop blew up. Let's see. Let's go to the weekly. Okay, so it really blew up August 14th, 2020. So let's go to 2020. Okay, May 24th. So this is going to show us what the financials look like for GameStop. And again, you can do this with Apple, Tesla, Amazon, Digital Turbine, AMD, what have you. So this was back when GameStop was $4.98. How would you have loved to buy into GameStop at $4.98 and sell it around $300? So let's just take a peek. As we can see, the market cap is 287 million. All right, so let's go to a screener. And we're basically just going to copy all of this over into a screener to show us companies that are going to provide similar results and could, in turn, potentially, there's never a guarantee, find a GameStop-like move. I apologize. My internet is being very slow right now. Okay, so the market cap is 286 million. So we want to look at micro, 50 mil to 300 million, which that's right in the ballpark of growth. So that's good. Let's go. Let's look at the book to share. Actually, let's look at the forward PE. So that is 11.61. So we're going to put low. It's going to be less than 15. That's great. That means it's probably slightly undervalued. That was weird. PE. Where's forward PE? Yep. Okay. Now we are going to look at current ratio. So I just need to click on the page. Current ratio, and we want it at 1.3. So we have over 1. That's a little bit that's a little aggressive. So less than 1, under 1. Let's do over, well, let's see. This is where it gets a little tricky. So quick ratio is a 0.6. So let's do under 1. With quick ratio, you want to be close to 1 as possible. I don't know why it keeps going back to the Wayback website generator. That's kind of annoying. So we have quick ratio under 1, forward P of 15. Debt is a very important one. Debt, here we go. Long-term debt, we'll put low because the 0.69 is pretty low. So we'll do under 1, which is good. Why does it keep going to Wayback website? I don't know. Okay, and it's not updating here. So let me just whoops. Let's go to incognito window because that will probably make it easier. I apologize for this. This is a little bit on the fly. We are at about 17 minutes, so I'm just gonna hurry and wrap it up. Screener, we're gonna do all. Market cap is small. All right, quick ratio is under 1. Great. There we go. 305 companies. It's going down. That is good. Quick ratio. Quick. Why isn't it? Oh, I already have quick selected. Sorry, forward. PE, we want under 15. That's good. Semi-unprofitable. All right. Debt to equity under 1. Yep, under 1. That is great. And we can see that our pool is now down to 57 potential companies. Let's go to EPS growth next year. That's a good one. EPS. Yeah, there's 5. Okay, EPS growth quarter over quarter. Okay, so there is EPS growth next year. EPS growth next year. We want over the highest it can go. Now we're down to 16. I think we can manage to track 16 different stocks that could have a potential move. And we are going to look at, let's see, shares float. Shares float is the amount of stock available. So it's 57 million is quite low. Oh my God, 99% short. That is disgusting. Okay. So anyway, let's go to float and we are going to look at so this ratio is pretty high. There's 66 million shares out there, 57 million are available. So whoops. Float. Okay, let's do under 100 million. Yep. All right, now we're down to 15 companies. Okay. Is there a short float short? Okay. We want high over 30%. There's 0. What about over 5? Okay. So there are 5 companies that are pretty shorted right now, that could have a similar move to um, GameStop. And if you see that I highlight on these, some charts kind of look the same. This one looks similar to the GameStop chart on the left. That's funny. El Pollo Loco, and an oil and gas drilling. Oil's been really hot, so I could see that coming down. So we have 2 oils that we could probably remove, just because, I mean, gas oil is going to be hot over time, but yeah, it's just not my cup of tea. So that's how we can kind of use the hindsight as 2020 30. Sorry, 2023. We can look at the past to predict the future. Here we have all of this. So now I'm going to save this screen as, okay, Ryan makes sense. I'm going to save this as the GameStop